the Next Generation Cost Segregation Study. Cost segregation is a tax strategy that has been used successfully for years to help property owners lower their tax liability by accelerating the depreciation on fixed assets, like an office building, through properly identifying every component of that building as preferred by the IRS. But is there more to be found? Engineered tax services like Next Generation Cost Segregation Study looks beyond accelerated assets and into separate building systems, tax incentives for energy efficiency, disposition of items no longer in use, charitable deductions of materials eligible for donation, accounting for repair and maintenance costs, and even reducing liability insurance premiums with a detailed engineering appraisal. With cost segregation, instead of a $15 million property having a tax write-off of only $384,000 per year, the tax write-off could be nearly $1.2 million per year. Think of an office building like a tall box that holds many individual blocks. If you pull out the separate building systems, like taking a block off our building, those components can help property owners increase their annual write-offs. Building systems include fire protection and gas distribution, the elevators or escalators, the lighting, electrical, and HVAC systems, just to name a few. And other assets like landscaping, flooring, cabinetry, and special lighting and electrical would qualify for shorter depreciation than the building itself. Having this detail in one report creates a valuable tool for property owners to ensure IRS compliance, optimum depreciation, and additional write-offs each and every year. Real estate can be the best investment for wealth preservation when tax rules are applied.
All right, well, hello everyone. Welcome back again. Good to see you all here. My name is Ben Yeager with Groundswell Investments. I have my partner here, Tim, with Oak Street Assets, and Kim Lochridge with ETF Cost Segregation Studies. So just real quick, as you know, I'm based out of Honolulu, Hawaii. I do multifamily investing alongside of being a super yacht captain. I got my intro into the real estate industry through my family. Got drug along to a lot of real estate conferences young, and as well as, working for really ultra high net worth individuals on super yachts kind of exposed me to the world of multifamily. And during COVID, the world shut down, so it gave us a really good opportunity to start our company and strategically partner with great individuals like my friend Tim here, and start building our company, Groundswell Assets. We're currently general partners in 408 units and about 93 million assets under management. So just gonna go ahead and introduce my friend Tim Fergstad here. Tim, go ahead and give us a little bit about yourself, if you don't mind.
All right. Hello, I'm Tim Fergstad with Oak Street Assets. I'm based in Phoenix, Arizona. I've been in real estate for many years. Started in single family, doing fix and flips and rentals, did some land wholesaling. I'm an agent here in Arizona, but several years ago I discovered multifamily syndication investments, and that changed everything for me. And so for lots of reasons, but one of the top ones is some of the tax benefits. And that's why some of the most successful investors have real estate as a big part of their portfolio. And we're going to talk about some of those tax advantages and benefits today, through the depreciation and accelerated depreciation studies, which cost segregation studies. We have an expert here today with us. We have Kim Lochridge. She's Executive Vice President for Engineered Tax Services, ETS, an industry-leading provider of specialty tax services in the United States. Kimberly possesses a powerful combination of real-world business management skills with a fundamental understanding and practical application of tax codes as they relate to real estate and energy efficiency incentives. So this knowledge and experience has uniquely positioned her as a big league tax expert for Fortune 500, high net worth individuals, ultra high net worth individuals, single and multifamily offices, architects, engineers, and CPAs nationwide. Ms. Lochridge is personally a real estate investor since the late 90s herself. So this activity has earned her a seat on the tax committee for the Washington, D.C. based real estate roundtable group, where she collaborates with top lawmakers and holds a variety of other board positions. And prior to joining ETS, Ms. Lochridge has spent over a quarter of a century in entrepreneurship, which had important roles within the real estate and energy industry. Kim is also a frequent multinational speaker in the tax, investment, private wealth, and family office spaces, where she altruistically shares her expertise with others, including us here today, which is awesome. So welcome, Kim.
Welcome.
Thank you, Tim. Thank you, Ben.
So, great to have you.
I guess. All right. So starting off, maybe you could give us a layman's terms of what cost segregation studies are and how they benefit the real estate industry.
Yeah, sure. I'm happy to. Cost segregation is near and dear to my heart because I use it daily as a tax strategy in not only my own portfolio, but I help a lot of other people use that as a tax strategy as well. There's multiple different ways of depreciating assets. A lot of people think that, you buy an asset, you have to depreciate that over, its respective 27 and a half for residential or 39 years for commercial. And that's straight line depreciation is just fine for most people. But when you get into the tax strategy world, doing a cost segregation study can be extremely valuable, especially now that we can couple that with bonus depreciation. And I'll kind of get into that a little bit. But essentially the straight line depreciation, so you buy a property, you depreciate it over either 27 and a half or 39 years respectively, depending on the asset type. And, it's just a straight line depreciation, right? You take that number and you divide it by 39 years or 27 and a half years, and that's your straight line depreciation. The IRS gave us, so back in the 1940s, we actually had our real estate pioneers who kind of fought back on that and said, there's really a lot of components in this property that are not going to last this long. And we would really like the opportunity to, depreciate some of these assets faster. Like carpeting is never going to last 27 and a half years. Flooring is not going to last that long. So, that's when cost seg was born, was because these court cases came up in the 1940s and 50s and 60s. And then ultimately we have these, court cases to refer back to, which kind of gives us what cost seg is today. So now the IRS says, okay, we lost those court cases, and now we'll let you depreciate your carpet over 5 years. And now we're going to let you depreciate your decorative lighting over 5 years. And we'll put your landscaping and your exteriors into 15 years. But the way that you can do this is you need to have a building professional come into the property and actually break down all of those assets so that we can have somebody who really knows real estate break those assets down and put them into their appropriate buckets in accordance with the IRS regulations. So it's hard for a CPA to do a cost seg study because they're not an engineer. They're not going to be able to tell you how many lineal footage of electrical is in that building, right? They're not going to be able to tell you the plumbing, right? And how that's broken down and give you an asset. And then on the flip side, engineers, could, or contractors or building professionals could do that, but then they don't know the tax code, right? So now you have this very unique business that is set up to, break down the assets in the building, create a condition factor for those assets, and then attach a replacement cost for those assets all in one report, and then deliver that to the IRS that says, we are breaking down this report. These assets belong in these asset classes, so therefore we're going to depreciate them over those class types respectively. So there's a 5-year bucket, there's a 15-year bucket. I'm sure all of you have seen some of these on when you're doing improvements or whatnot. Your CPA will say, oh, you did carpets, put in 5-year. So essentially, instead of depreciating it over just that straight line long-term asset, we use the Makers methodology, which is a tax term, but the Makers methodology is what we're doing to break down the assets, and we're allowed to put those assets in faster buckets. Okay, so now if you can depreciate it faster or over a shorter period of time, you're paying a lot less in tax up front. And the reason that the IRS allows us to do this is because they're recognizing that these assets that are put into these faster buckets are not really going to last any longer than that. So over the course of the ownership, you don't want to depreciate carpet over 39 years if it's only going to last 5. Okay. So these are the options that they give us. There's another methodology called ADS, which is reserved for foreign real estate and other things, which we won't really touch on today. But so the cost segregation is essentially as a reallocation of the bucket, so you don't have to depreciate the entire building over that long-term asset.
Okay, so you get a lot of the
Long-winded, I know, but
depreciation. Yes. Yeah, there's a lot of details there. So basically, you have specialized engineers come in and depreciate some of the property sooner. So you get some of the tax losses on paper sooner.
exactly.
And why is that good for investors?
Well, as an example, if you have, I'll get my trusty calculator here, but for let's say every $1 million you have for depreciation, if you're depreciating that over 27 and a half years, like for multifamily, you're going to be depreciating like $36,000 a year. And that $36,000 a year is going to offset your income from that property. Okay. If you do a cost seg study, for instance, and then we were able to take, let's just say roughly 30% of that, then it's going to be broken out into chunks. You're going to have like 20% of the building that goes into a 5-year bucket, 10% will go into a 15-year bucket. And so then you just have a whole new depreciation schedule. And it's a little bit more complicated. CPAs tend to really like the same depreciation every single year. But this kind of jacks with that a little bit because you're going to have a 5-year schedule, a 15-year schedule, and then a 27.5-year schedule for your structure. But there's one other key point that I think that really hits this home and why it's becoming such a mainstream tool as far as tax strategy goes, and that's bonus depreciation. I'm sure you've all heard about it, but essentially, if we go in and reclassify, let's say 30% of the purchase price or the depreciation asset in 5 and 15-year buckets, the IRS comes in and says, as a result of reclassifying these assets, we're going to give you the ability to apply bonus depreciation. And that means that if this is in a class life of 20 years or less, which is those 5 and 15-year buckets we talked about, then you don't have to wait 5 and 15 years for it. You're going to take the deduction all right now. So we're going to give you this huge tax planning tool to be able to say, hey, if I purchase this property and I'm able to write these numbers off, it's very beneficial. So going back to my calculation, instead of depreciating, say, $36,000 over the course of, every year in 27 and a half years, with bonus depreciation, if we reallocate 30% of the property on $1 million basis, that means now you get a tax deduction of $300,000 in year 1. That's the year you purchased it.
Yay.
That's huge. Now you're going to have a little bit less. So let's give you an example. Instead of $36,000 a year, you'll depreciate that $300,000 up front, and then your remaining depreciation is $25,000 a year. So you're really only losing, what is that, like $11,000 in depreciation each year, but over the course of 27 and a half years or however long you own that property, you get that money up front. I kind of liken it to if I am scratching off a ticket and I win $40,000, right? And I go to them and say, hey, they'll either give you $1,000 a year for 40 years, or they're going to give you $40,000. Obviously there's a little discount usually, but which one do you want? And I start thinking about, as an investor, I'm going to take the $40,000 up front because I can do a lot more with that, and I can invest in other, property, or I can use that for something else. Whereas if I had $1,000 a year and they're just doling it out to me, I would literally eat it because I'm a foodie. I would literally spend it on groceries because $1,000 a year is nothing, right? So, but now you're talking about something that I can actually turn and burn, and I can do something with it.
Sure.
That's really the power of cost segregation.
And the time value of money, right? You're getting that money up front. You can do something with it before you have to pay any taxes on it.
Yeah, and obviously it's exponential, right? For every $1 million, you're getting $300,000 up front. I mean, that's exponential, especially with some of the deals that you've done.
Right. So let's circle back a little bit for CPAs, for example, not wanting to do a study, or some people I think have even maybe tried to do them themselves. How does that work when they get audited? How often does that happen, and defending the study?
Yeah, it happens. But IRS has been very busy lately. So even, I've been doing this for a long time. Our company's been around for 21 years. We've been doing cost segregation and, morphed with the times. But, if a CPA does it, it will probably be fine. They give us different tools. They have, a square foot analysis where you can just basically go in there and assess the square footage of the building and then take out estimates. But that's not an engineered based study, and likely it's not going to stand up in the event of an audit, because all you're doing is using it as a comparison. Usually people are not visiting the site, which is required by the IRS in an engineered based study. So we actually send an engineer to the site. We're legit, right? We're not just sending a photographer. Like this is we're not cutting corners, right? We're doing it correctly. We also offer audit defense. So if there is ever a question from the IRS, we answer all those questions. Your CPA doesn't have to you don't have to have billable hours for your CPA to deal with that. That's something that's really important too. So how these stand up in an audit really depends on who you choose as your provider, right? You want to make sure that they're doing it from an engineering standpoint. When we do our caustic studies, we're rebuilding that building on paper from the ground up using construction software. So when we're doing this, we know exactly what's in there. And I can actually show you some examples of the study that we finished. If you like, we can do a screen share and just show you some of the engineering pages, if that's helpful.
Sure. Yeah, one of the reasons we're so excited to have you here, Kim, is because, as a lot of people that might be watching this did invest with us, and they partnered up with us at 301 Greenville in Allen, Texas recently, as we closed that deal in September. And perhaps, as you show and walk us through that, say, one of our investors, they invested $100,000, that's a 7% preferred return to them. So they're getting $7,000, per year back on that investment. Maybe you can also walk us through and show us what it looks like for those if they don't actually have a good picture of that, specifically.
Yeah, so I think I do have in this report kind of a what the depreciation would be if they didn't. So I'll just do a quick screen share if you're okay with that.
Fantastic.
Okay, so I've got the caustic study up if you can see my screen.
Yep.
So this is the project for 301 Greenville Apartments. And this one actually turned out very nicely. So I'm thinking about 30%, but we ended up with about 37%. So we got 25.93% in the 5-year asset. I think it's a little bit bigger. And then we were able to get 11.02% in 15 years. So this one performed much higher than what I anticipated even, which is always nice. And you see these big numbers. So you got your total depreciable basis. This is net of land, was 38 million and change. We were able to reallocate from that 38 million, 9.8 million into 5-year asset, which gets, remember, depreciated over 5 years. And then the 4.2 million over a 15-year class life. So let me show you what that means in dollars. This was kind of the breakout, no big deal there. But this right here, this number, the 403 would have been what your depreciation was for 2022 had you not done the cost segregation study, okay? And so you would have been able to deduct about $400,000 against the income on that property, and then whatever's left over, you'd be paying tax on, okay, as collectively as a group. But instead, because of our cost segregation study, and because of the qualification of the bonus depreciation, we were able to get a tax deduction of 14 million.
Wow.
Over instead of 400,000, we got 14 million as a tax deduction for the first year. Now, this is going to trickle down to each of the investors in their K1, and it's going to show a loss. And they're probably going to be calling you if they don't watch this video, and they're going to be like, what the heck? You guys sent distribution checks, but my K1 shows a loss. You made a mistake. Your CPA suck. Because that happens to me all the time. And then they call me and they're like, what? They're like, no, wait, we did a cost seg study. So then they have to go explain that. So hopefully your investors will watch this video and understand that, it's not a mistake. You really do have losses. If they are a real estate professional, the nice thing is that those losses that trickle down into their K1s, into their portfolio, they get to use that if they're grouping their properties together and offset other income on that level. If it's a passive investor, then the same thing applies, but it's applied to their other passive income.
Right.
So
into
say
group and
I'm
together.
invested in this deal here, and I also have say I own a fourplex as well, and I
Mhm.
haven't done a cost seg on that. Does this blanket my fourplex as well on my returns on there?
Yeah, if your CPA is grouping those assets together, then yeah, it's just going to be treated as one entity. All the income comes in and then all the deductions come in and then it just offsets and flows through and you end up not paying any tax. So it's a beautiful strategy and you can see how it works, right? And how much more lucrative it is instead of just taking your 27 and a half year, depreciation. So that's the one thing I wanted to show you. And then going down to the actual engineering pages, which is super exciting to me because this is something, a lot of people are like, oh, you're charging me too much for the study and blah, blah, blah. And then you're like, well, there's a lot of work that goes into this. These are all the depreciation schedules. We'll skip over that. But this is the summary page, okay, of the
Right.
breakdown of the engineering. This is just the summary page. So you'll notice that the asphalt shingle roof and the wood floor construction. You'll see, water, gas. There's usually about 4 or 5 pages to the summary. This is what everybody else's normal depreciation or normal cost study looks like. It looks like this. But we actually go one step further. So this is the summary page. You'll notice that we have a replacement cost. We have the soft cost included. We have a condition factor of, because when you buy a property, not everything is going to depreciate or hold up at the same level. You might have the roof that's 20 years old, and then you might have had all the HVAC that was replaced 5 years ago, right? So you have to have a condition factor. We've been commended by the IRS on that. But you can see, remember the asphalt shingle, which I had the single. Now I've broken that down to exactly what it is, what's the quantity, what's the square footage, what's the depreciable basis of each of those assets. And this is why these reports stand up in the event of an audit. So this is all the structural, the 27-year assets. If we go down, you'll keep going into like the 15 and the 5, like here's 5-year assets, right? So the sinks and the carpeting pad, all that stuff. So it breaks down everything in that building, which is just so dramatic and so helpful that that it's just going to stand up in that audit, right?
Right.
Wow,
So Kim,
what an incredible tax savings for our investors, and what an incredible benefit for anybody thinking about investing in multifamily, to ensure that the operators that they're trusting with their capital are actually performing one of these studies.
Yeah.
So on the other side of that coin, though, maybe you talk a little bit about how you do a preliminary or a benefit analysis before you decide whether or not a cost segregation is prudent, right? And maybe some of the myths associated with size and stuff for whether or not a study is worthwhile.
Yeah, I think a lot of people I hear, some CPAs, and I'm not dogging CPAs because I work with thousands of CPAs across the country, but there are some that I still have that push back and they're like, oh, it's too expensive and it's too this and, it's too that or whatever, it's too difficult, whatever. And it's just because they don't have a good resource. So if they say that to you, please introduce them to me and I will show them the error of their ways. But as far as this goes, I think that it is one of those sensitive topics. CPAs are not engineers, and sometimes they just don't have the resources, to go in and make it work, or they don't even know where to send you. There's like, hey, if you want to do cost seg, great, and then just send it to me, and I'll figure out how to do it from there. Or maybe they do understand it. And maybe they'll send them to us, but yeah, it is important to have all of the detail and the backup documentation. We offer audit defense, obviously, so you're covered in that realm as well.
So is there like an age of property where you might say, oh, this is too new or too old to warrant a cost segregation analysis?
Well, properties change hands so often, and that's one of those things that you're buying it, you're paying a certain price for the property, and it's new to you. So your depreciation starts from the time that you buy it. So I would say if you've owned it for more than 15 years, not the age of the property, but the ownership is more than 15 years, it's kind of sixes. If you were going to do that, it would be more for a tax strategy for that particular year, because maybe you have a big gain that you need to offset or something else that you need to do with it to make up that depreciation. But as far as, the age of the building, it could be a 50 or 100-year-old building. We're still going to do a cost seg on it because it just changed hands, right? So
Right.
I would say, as long as you've purchased it or owned it or built it within the last 15 years personally, then I think that's still a good still opportunity for you.
Okay. And how about, can you talk to the size of the property? Big versus small properties, the rumor or myth that you don't bother to do cost seg under for smaller deals or projects.
Yeah. I actually have a group of doctors that I work with. Love them to death. There's probably 400 or 500 doctors in my repertoire that I work with, and they're out there, starting their investment journey, and they are buying short-term rentals because maybe they have two incomes and they have two W-2s and they can't justify a real estate professional, but they want to offset some of their income with some real estate and some depreciation. So they're out there buying single family homes to do short-term rentals, right? Vacation rentals. And then the depreciation, because they meet this material participation, maybe their spouse stays home and whatnot. And so they end up running it.
As long as the short-term rentals qualify as active projects.
Well, they would if they meet that material participation.
Yes.
Yeah. And so what they're doing is they're in this university and they teach them how to do, make them the material participation so they can offset it. So we do everything from a short-term rental or a single family home all the way up to a trophy building in Atlanta, Chicago,
Right.
I'm working on a big Chase Tower, right now. So can't tell you what state, but you would know it, Tim.
Okay.
So, those are the things that we're working on, and it doesn't matter. I mean, if you have a basis of $150,000 and then you get a tax deduction of, say, 45,000, that could be a lot if you're just a starting out investor. So there really isn't a limit to how small the property is or can be.
Okay, excellent. Thank you. So sort of bookending this with what do investors need to know, and maybe what their CPAs and preparers need to know?
Well, I think one thing we need to touch on is recapture. And I think that's an important topic as well, because if you sell the property, you're going to have some recapture to pay. You're going to have to pay back the depreciation, right? Not all of it, it's prorated, but it's kind of like, I start a new job. Let's say I come to work for you, Tim, and I say, hey, give me an upfront pay for 5 years. Just pay me all my salary for 5 years upfront. And then I quit my job in year 2. That's kind of like taking bonus depreciation and then selling the property. You kind of have to pay back what you didn't perform. So that's an analogy that I use that people can relate to in that, but it is true. So there is some recapture to pay, but the nice thing is that we have so many different things. If you do a 1031 exchange, for instance, you don't have to pay the recapture, worry about it, because it gets rolled over into the new deal. If you do. If you still have some good bonus depreciation, you sell a property 1 year and then you have a purchase of another property in the same tax year, you can actually use that bonus depreciation to offset the gain from the sale. So there's all these tax strategies that help you get out from underneath the recapture. I think a lot of the CPAs basically are just like, oh, don't do it because you're just going to have to take all the deductions and you're going to have to pay them back later. But I'm an investor. Right? I'm going to take all the tax deductions I can today. I'll worry about 5 years from now in 5 years, right?
Or even next year.
Or even next year.
Right.
Exactly.
So we sometimes call syndications lazy person's 1031 because just less hassle. You have more options, more freedom.
It's true.
And I wish I would have known this. But we had a capital event years ago where a business buyout. We had all the capital gains to pay, and I wish I would have known. I could have put a lot more into these sort of investments to offset the taxes due on that.
Exactly.
The long story short, Tim, is just invest in real estate deals. Yeah,
that's right.
Indefinitely.
Well, hey, as we close it down, thank you so much, Kim, for being here with us today. If, say, any of our friends out there are listening or watching and they want to get in touch with you and have you take a look at their project or their building, what's the best way for folks to get in touch with you?
Yeah, thank you so much for that. I appreciate it. So my email address is K Lochridge, and my name's on the screen. So if you don't have it, it's KLOCHRIDGE at engineered with the ED on the end, tax services with the S on the end. It's a long one, .com. So K Lochridge at engineeredtaxservices.com. You can email me. And then, my direct line, I'll just give you my direct line. Call me 971-213-8686. If you forget all that, engineeredtaxservices.com. I'm also all over the website. You can just Google search my K Lochridge or Kim Lochridge. I'm sure I'll come up somewhere. I've got lots of articles and things out there, so you'll find me. But thank you for the opportunity so much. And thank you for working with us. We enjoy being a partner to you guys. And if there's anything else we can do, you let me know.
All right.
Fantastic.
Thank you. Thanks for sharing your time and your knowledge. This has been great. Thank you.
Anytime.
Thanks so much, Kim. Have a great evening.
All right. You too. Bye-bye, guys.
Bye.
All right. Wow. What an amazing and informational presentation by Kim. Thanks for sticking around. If you guys want to find out more about 301 Greenville Apartments in Allen, Texas, that she was actually talking about in the presentation with those numbers, you guys go to groundswellassets.com/invest. And you guys can get everything, access to the deal room there, and see all the numbers and details on 301 Greenville in Allen, Texas. We'll catch you guys next time. Aloha.